Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 28th, 2022. In this video, I will start out with an update on the equity markets, some things to watch, highlighting some levels where we're at right now. I'll do a brief update on the FANG stocks as well, because that's obviously going to help us figure out which way the market's going from here. I want to do a very brief update on the VXX trade, and then gold, silver, and the euro. There's some things I'm seeing there, and then I'll update those recent what I call trash stocks, aggressive trades that I threw out recently, including TMBR and the pot stocks. All right, sounds like a lot, but I'll whip through this pretty quick, relatively quick. This is QQQ 60-minute chart. We are at that three. This is resistance here. You had a little trading range right there. You had a big down followed by some consolidation. So we're at resistance, price resistance. The divergence that I pointed out last week is still very, very much intact as of now. Doesn't mean it must play out, but this is what I look for, these 60-minute divergent highs and lows, and that's what we have. What I've done here is added a little micro trend line here. Remember, on the 60-minute chart of QQQ, we have, this is my primary uptrend line. We broke down last week. We back tested a couple times, and we're stalling out around that level. So we'll call it a near-term battleground between bulls and bears. And what I think will do the trick is a break of the secondary trend line. There's enough clean reactions on it. That trend line comes off the lows, looks like the 16th of the month there, March 16th right there. And so that should do it. And again, minimum target's going to be down here. I'd say at least, I can bump this up a little bit. Let me do that right now. Tighten it up with the where I see that resistance coming in, about 351.70. And again, that would be the first minimum target. Could certainly do more. So you might want to just trail stops down. And again, it's up to you. We want a quick trade. But remember, in bigger picture, and I'm not going to go into the long-term charts right now, not out too far, we are still, I won't go into detail, but for those, catching up, you can't see them here because I have the levels turned down. You have the big 200-day simple moving average just up there overhead, and we're just a hair above the 200-day exponential moving average. We also have good price resistance here. Remember, back a while ago, I had a big support level at 360 on QQQ. 360 to 362, those are the lines. It's a resistance zone, and we're at that as well on the daily chart. And so that's what it looks like there. But I wanted to show you a couple other things. Let's jump back, and let's go back to that 60-minute time frame. Let's look at the fibs. I'm just going to walk up these boards. This one right here, this trend line that we are back testing goes all the way back. If you take that trend line back and use a log scaling on your chart, that goes to the COVID lows, the March of 2020 lows. And this is where we broke that trend line right here. On the again, you see it better on the daily or weekly chart. We back tested it, got rejected, and we're back testing it again. So that's something worth noting. And then you can also see I have some fibs here. Let me go to this one right here. We have a fib cluster, at least two significant Fibonacci retracement levels. Again, we're on a 60-minute chart. Let me squish this down just a bit so we can see the price action a little better up top. This is the all-time high right here in the Nasdaq 100. Happened back in November. You had a slightly lower high, so that's the major reaction high. And we are to the button. We just hit. I mean, to the button. Close enough. The 50% Fibonacci retracement level. It's this yellow line. I know it's hard to see in the video, so I'm just going to draw it over. You can do that again on your own charts. Just pull that fib down from that high to the very recent lows right there, and it'll give you the 50% fib. Then you also had, after we topped, we made a slightly lower high, and then we had a first nice big counter trend rally here. So if you measure from the top of that down to the recent lows as well, that is the 61.8 Fibonacci retracement. So there's a fib cluster right there, and based on the long-term outlook, which hasn't changed, my longest term chart yet, still think there's probably going to be another leg down, and therefore this is an objective shorting op. It was last week. I pointed it out. I'll get to the VIX trade in a second. That already effectively hit the first target today, VXX. But before I do that, let me let me just show you a comparison here. We're on the weekly time frame, and I've got fibs on this level. Okay, so I'm going to zoom this in. I wish I didn't have these lines here. I'll clear those out later. Let me just show you. I already, on the 60-minute chart I just showed you, I should say, that was the all-time high right there. And that was the recent low. And there's that 50% fib. Again, hit it to the button. So, we can sit here and debate all day long whether this is a counter trend rally with more downside to come, or it was just another correction, a great buying opportunity on the road to new highs and beyond. Only time will tell which one that is. But what I can tell you is, we're going to go back in time now. It's best to just keep this in recent history. I'll go back to the only two comparable corrections, I'm talking in scope, where the market dropped roughly as much in recent years. And one of those is right here. We'll start out here. This high right here, the week ending Friday, February 21st, 2020, is when the Nasdaq peaked right there, that candle. And so I have a line there. I just moved it to the left so I wouldn't block the candle. It measures from that high down to the to the first low. So we had a first wave down, and then you had a counter trend bounce. That counter trend bounce was about 10% or so, if I recall right. I'll measure it for you and tell you exactly how much it was. It was 10.82, 11%. So a pretty powerful, aggressive bounce. And again, I'm measuring right there from the highs down to the lows, and you can see here I got to move that line up just a hair. I see I'm slightly under it there. I think that snapped to it. And hopefully you can see in the video. If not, just replicate this on your chart. We were right between the kind of blocks it there, a hair above the 50% Fibonacci retracement. The 50% fib is there, right about the top of that candle. There's a 61.8. And so where am I going with this? I'm just showing you that this was a case where the dip buyer stepped in, and the bulls thought that the correction was over, and they bought the dip, and they had a much bigger wave down to follow there. And so again, the point I wanted to make is, and I've talked about this often, that's what a typical counter trend bounce, assuming that we are in one now within a larger down wave or down structure, a typical counter trend bounce will usually run, not always, but usually about 38 to 38.2% Fibonacci level, retracement level, up to about the 61.8. That's just the norm, somewhere in that range, and that's what happened back then, again with more downside to come. So now we'll just take it back a little bit further, and we'll go back into the only other time we've had a correction to this, close to this magnitude, back in the fourth quarter of 2018. So I did the same thing. There's your all-time high back there in late August, or at that time it was, and there was your first wave down. We made a roughly equal high right there. Still, it doesn't matter. You start at either point, it's the same price level. Measure down to the end of the first wave down, and you can see here, if you can, I'll walk it through. I cannot make these numbers larger on this platform, but that's the 50% fib right there, and here's the 61.8 above it. So we went right between, we split the difference between the two. Again, it was a counter trend bounce, no doubt. If you were buying stocks at that point, it felt bullish because it was a 10% bounce. And keep in mind, it also stopped right at that the 200-day moving averages, just like that other first drop stopped on them and bounced from there. And again, so that speaks to the importance of the 200 days, you can see there. But again, I just wanted to make the point that that was, felt bullish by all counts, depending how you were looking at the charts at the time. I know we traded it. I know we were short most of that leg down. I know we gamed the counter trend bounce and caught most of the next leg down. So that's it. I don't want to beat a dead horse. I just want to tell you that right now I'm still going off my primary view. I knew I saw the divergences. I mentioned those a few weeks ago. Told you, even went long in my trading account, gamed, the first part of it, and then even pivoted on some of my swing shorts by closing those out because of the 60-minute divergences. And now at this point, let's just go back to where we are, and then I'll wrap up. I think at any point, I don't know when, but I think at any point, if I am correct and there's going to be another leg down, any one of these resistance levels, especially when you get here around the 200-day moving averages, which you already took out, back tested, and failed once, you get back to them. That's very objective level to short. And where do I stop shorting? Again, if we get above that 378 level, that's where I would stop adding to any short positions and start be more concerned with scaling out. But as you guys know, I started scaling in last week, and still think we're probably have a red week this week, probably close red. So point is, it's still objective in my opinion to short. Right now, we're still at resistance. We broke the the first uptrend line, which is more important, and back tested. And then on that, I told you I'd update the fangs. Here's the 60-minute chart. There's that price channel on Apple, as I told you, very long in the tooth. And then we had a divergent high, and then we broke it. We had a big red candle. We hit the first support level. That's 172. Bounce, and there we are. So we've stalled out. Bears need to see this 172 level get taken out. That should leave us more downside. I'd say at least a 167.90 right there. And as I mentioned last week, there is some decent resistance just overhead. If it wants to have one more thrust up, ideally you'll see us, and if it happens soon, you'll keep the negative divergences intact, and still that still remains a target. I mean, we're talking, if you took the breakdown of the channel and you shorted Apple, let's say, or you shorted the Qs, you're only talking less than 2% to run up to that level. So especially if you're swing trading, you could have a stop 3-4% above and still have an excellent RR. And that's it. So when we start going through that level, it starts to chip away at the bearish case if they can just take that out. And again, Apple's one stock, so I look at everything collectively, all the indexes, all the market leading stocks like this. This is Microsoft. There we are. Big resistance, pretty decent, around 312. Negative divergence, same that I showed you last week. It just extended a little bit today. And there's Amazon. Amazon, big divergence. I read an article today on, or was it maybe yesterday, about oil and gas prices going up, and we're already, we already crossed the $100 barrel mark. We're above that now. There's rumblings out there. We go to 200. Who knows where we go? All we know is it's very unlikely to see oil come down significantly. It's already at high levels, historically high levels, and I forget the number, but it was huge. If oil, or maybe it was diesel fuel, if it goes a certain price, the amount of additional fuel costs Amazon has. Remember, they have their own fleet now of delivering. They've been building on that. They have electric vehicles coming, but I think that's supposed to be 2040, if I'm not mistaken, the year 2040, before they're fully electric on their vehicles. So it's not going to help them anytime soon. And so when you wonder, okay, the economy is so strong, and I see it, there's still supply demand, imbalances. But again, that's it. So let's just tell you that the Amazon, let's not ramble on too long. We all had, or all the big fangs had, these big 60-minute bullish falling wedges, which I pointed out. We broke out, we rallied up, and in a bull market, these should be the catalyst to new highs and beyond. If they are not, it tells us we're in something different. If we come on a back test, great. Maybe they both still have a chance. Anything more than that, you take out the trend line, you're going to undercut those lows. At that point, we should be in the next leg down in a bear market. And where I'm going is, look, you've got these 60-minute divergences. This is when I like to short, when everyone else wants to buy right now. Everyone else thinks the correction's over. They see these fangs going up. They see the meme stocks going up, and junk stocks, which I'll get to in a second. That's when I like to close out longs and start getting short again. And all right, so let's not spend too much more time on that. There's Tesla, broke the trend line. It's kind of acting wonky, but back testing, just like Apple and Amazon, everything else, broke down and back tested the trend line. Alphabet right there also broke down its primary 60-minute uptrend line, bearish rising wedge pattern and negative divergence, and blah 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 blah. All right, so that's it. I like it. I like it short here. Most people don't want to short because they see the market being resilient, and maybe that's what's going to continue to happen. I like shorting here. I don't want to short tomorrow if we gap down 2-3%. So I've got a comfortable allotment of shorts right now. Let's just leave it at that. Alrighty, next up would be VIX. Okay, I talk about this all the time, and I think this bears repeating that I lay out price targets, and for the most part now they're what I call, and I've always referred to as unadjusted price target, unless I say T1 equals. I put an equal sign, it means I've made an adjustment, but it gets confusing because I like to leave the resistance levels up, A, so I can see them, and B, you can see them as well. So back in the old days, I used to do what I called official targets or adjusted, and I would temper it down. Where I'm going with this is the how much you sell on a long position, how much you sell below the actual resistance level it's a function of many things. A, the price as a security. Let's say you're trading a $2 stock and your price target's $2.20. Yeah, you can get only a couple pennies below is fine on that in most cases. You're trading a $200 stock, a few pennies is not even, you can't even register that. It's a small fraction of 1%, so you're talking several dollars below. And something like VIX, or a VIX tracking ETN that moves up, my first target, I added that on just last week, because we had pulled back to the former first target, which was resistance, hit here, and then becomes support, and it's been support for about a week. When I saw that support holding, and based on my outlook for the market, I added that on right around right around that 24.58 level, maybe wherever it was, a little bit above it at the time. I know we were close, and boom, we spiked and hit today. So the VIX keeps giving us these gifts. This one, I'm using this VXX. It's weird. That day we hit that third target, and again, that's close enough. Just like this, we didn't exactly hit 30.79, but you can see on the chart we came close enough. And so where I'm going is that is good for about a 20% gain. First target 25%. So what you'd want to do on a 25% target on something very volatile like the VIX, you don't try to put your sell limit order a penny or two below there. You go several percentage points, in this case a couple percentage points. That's it. We came within 1% of that target, so that is hit. T1 is for all intents and purposes hit. And what I was getting at a second ago is we keep getting gifts with this one. It's not doing a perfect job. It's doing a good job of tracking the VIX, but it keeps having these spikes. Like the day we hit that fifth and final target, remember these were my previous targets, we had just an intraday rip up that was not proportional to what the VIX did. We had it helped, it worked to our advantage, and we had that again today. You probably noticed if you're in this one, had a huge spike at the open. There's VXX, that's what we're in. You can't buy the VIX directly, so you have to either do futures, options on those futures, or you buy one of these, and that's what I put out there. I know most of you, a lot of you don't have, options or futures account or the experience. We did get a half decent pop this morning. It looked like a single. Look at that. It was almost a wonky candle. It popped up and then got faded. But either way, I'll say this: I'm sitting tight. I didn't take that. I'm still holding on to the VXX because I think we're going to get more out of it if I'm right, and we'll close down this week. We'll probably come up there and hit at least my second target. That's why I have potential third, fourth. Why do I have that? Because if we're just going to get a correction and the market's going to continue to move higher, maybe test the 200 simple moving average or some of the price resistance levels above, or maybe we're in a multi-month sideways range, then this is what's probably going to happen if we just have a little correction. We hit those near-term targets that I laid out earlier in the video, as well as last week in QQQ and the market-leading FANG stock. So, you can consider that the final target. But as I said, there's a potential that at any point now the counter trend bounce can be over. We've hit the 50% fibs. We've hit the 200-day exponential moving average in QQQ, close to the simple. And so these would be your targets if you just want to trail up a stop, and let it run. These are the potential targets. And if we were to hit, let's just say we go on to hit my fifth target, it's about 157% return from where we entered last week. Okay, brief update on gold. So longer term, I still like that. Still hold in my long-term account, still hold position of gold. It's kind of consolidating recently. Remember, we had this big symmetrical triangle. We hit my buy zone. That was, if you're new to the site, I've been long and bullish gold from the bottom back in 2015, late 2015, early 2016. But here, put it on as a short, said getting out of all my long-term gold mining and silver mining stocks and gold because that was a long-term resistance level. It was a previous bull market high in gold, and said we could be looking at a multi-month correction, and that's what we had. And then I laid out that buy zone at the time. Here it was also on. I have different boards. On the daily chart, and we had multiple opportunities for a long-term investor to scale back into gold. And then most recently, for the last few months, I was watching this symmetrical triangle. Said that would trigger the next buy signal. We did. We broke out. Then when we hit there, I said, look, I took profits on the gold position because we hit that high again. It's a major reaction high. But look, now that we've checked it, it's all clear. I think the next time we get up there, we'll probably take it out. But look, we're consolidating for now, but we are well above the breakout point. Until and unless gold fails this breakout, falls back down within the triangle or below it, then I still view it as a buying opportunity. Pullbacks. What it's going to need, the dollar's been strong, and we could use a boost from the euro, and I think we'll get that soon. Here's what I wanted to update you on. This is a 60-minute chart at E7, euro futures. You get these little divergent highs like this, and it leads to corrections. Then you had a little divergent low right there. See positive divergence. You had a rally. Then you had a divergent high right there, and then you had a big correction. It was a pretty good divergent high. But most recently, you had, from this point to here, you had positive divergence on the euro, and it's been in an uptrend. An uptrend being defined as a security making a series of higher lows and so far higher highs. So what we need to see to keep that uptrend intact is to get this previous high taken out. It's also resistance. It's also my next target. And what will be the catalyst for that, I think, is you have a decent downtrend line right here, and you also have bullish divergence right there. Positive, aka bullish divergence. So there's a little bullish falling wedge. Pop that, run up again, check. We've already checked it a couple times. 111.66. Maybe one more action, maybe not, again, because we've already checked it a couple times. And then ultimately, I think we can swing up here to that 113.26. If you do not trade futures, you want a pure play, trade the euro. I use it mainly I'll trade it sometimes, but I use it to really kind of help align my entries and exits on gold and silver. FXE is your one-time non-leveraged ETF, bullish ETF for the euro. Or you can of course trade E7, or just go in gold and silver, because if this breaks out and we start to run, that should be bullish. Rising euro equates to a falling dollar, and that is typically bullish for gold. And now, quick update on the those aggressive stock trades. TMBR, not much to update. It's down 7%, but that's actually nothing. That's a lot less than it was up on Friday. The breakout's still very much intact. Do I love this stock? No, I'll never fall in love with especially a penny stock, but there's no technically significant changes. This is noise. When you have a low price, a penny stock is going to go up and down 10% or more in a good day. So this is just a pullback. Would have been nice to see follow through today, sure. And like I said, I'd just consider a stop below that uptrend line, a little bit below it. Somewhat, it's up to you. You could allow for a full back test, but I'll tell you what, if we come in for a full back test, it could still go, but you really want to see these guys follow through. You want the momentum traders to follow up and get in on it and pop it up there. So again, no real change today. Let me move on. Before I get to the pot stocks, which we'll wrap the video up with, remember, the whole theme and why I started looking at these low priced, or what I call them junk stocks. I don't care. I'm not marrying these stocks. I want to date them. They're my Tinder dates. They're not my Match.com forever. That means your Apple and things you're going to tuck away in your account, your investment account, and hold for years. Whereas these are just hit and run. These are trading vehicles. Could care less about the fundamentals. Found this ETF called Meme, as the name implies. They invest in meme stocks, and their top holdings. Let me grab that real quick. I've got them up here on another monitor. Number one, of course, is GameStop. And so, see, the dash for trash continues right now. And so there's still a chance for the pot stocks and those others to continue. Plus the technicals are strong on the pot stocks, just like these. I told you GameStop, I didn't see it at the time, but had positive divergence. Also hit my, that was, yeah, that target down there. I had a support level from way back when at 90.46. You have AMC is the second largest holding. And again, I'm just showing you that the retail crowd, the Reddit group, whatever you want to call them, they're still in these meme stocks. That was my top of my former second target zone, which was hit back here. We hit all the way down to my third, almost to my fourth target, and then put in a bullish falling wedge. I'm talking about the last short. Well, gosh, I can't even remember where it was, back here or here. Shorted it here. Oh yeah, right there on the break of that trend line. So T1 was hit early on, then we consolidated for a few months, took out T1, back tested it, hit T2, T3, T4, or almost T4, bullish falling wedge, and that wedge is playing out just like the one on the indexes. And you have next resistance 2883. So again, this wasn't one I threw out to you. I talked about it recently, caught the fact these were moving. And down the line you have DocuSign, is their third largest holding of that meme ETF. So and just like AMC and GameStop, these guys are in a bear market. They are in a downtrend. This is a counter trend bounce, a bear market rally. Why is it a bear market rally? Well, DocuSign, for example, has dropped about 77%, almost 80% off the highs, and it is clearly in a downtrend, and it is below all its key moving averages, and so that's that. So I'll play a dash for trash. When in Rome, do as the Romans, and so I'll game these stocks. Let's get to those pot stocks real quick, and we'll wrap this up. Not much significant to report today. I gave you these targets. Remember, in the after-hours session, that third target was already hit, but during the regular session, T2 so far capped the advance, and a little pullback today, but doesn't change anything technically. The breakout is still very much intact. This was the breakout here, so it's just a down day, and the music's still playing, at least maybe not at the very moment in this sector, but the breakouts, well, that one actually hit that first target, and so far it's stalling off there. Needs to take out the recent highs. So that's actually the story on all these pot stocks. They need to take out their recent highs, and as long as the music keeps playing, I think they can. You can start to draw some downtrend lines for if you want tight stops, or you can give it room, like on CGC all the way back here to 676. That's support roughly. And remember, a lot of these already hit in after hours, so these still remain. If you didn't trade them out, take any profits in after hours, you can certainly swing at it again. It'll probably come into play as resistance again. So that's it. There's really not much more to update. They're just taking a breather today. Nothing goes straight up. You look at Chronos, CRON, and in the matter of that's a 44% return. 1, 2, 3, 4, 5, 6, 7, 8, 9 trading sessions. Those 9 trading sessions, 7 were green, 2 were red, and it was about a 45% gain, and it's taken a breather today, and it's still in an uptrend. So that's that. Nothing much else to add to these guys, and if the music keeps playing, this one has taken out, or took out, the previous reaction high the other day, but it's pulling back. So it needs to, again, the common theme is, I think if we can pop Friday's highs, then we should head up to the next resistance levels or targets in these. And if not, don't get married to them. Like I always say, it's like a game when you're playing momentum stocks and stocks with questionable or not so solid fundamentals. I mean, none of these are Apple as far as their balance sheet. That's speaking lightly. You just don't fall in love. They can run, and when they want to run, they can really run. Or this may just be another bear market rally. They popped here, had a few days of big gains, and then boom, the downtrend resumes. So that's that. All right, guys. I will wrap it up here, get the video out to you, and yeah, that's all I wanted to cover. If I see anything else that stands out, I'll let you know. I'll do an end-of-day video. Otherwise, if we close around where we are now, we'll just pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.